The next topic is benefits to the investors. The following are the benefits for the investor. The first one is bad deliveries are almost eliminated. The risk, second one is the risk associated with physical certificates such as loss. Theft, mutilation of certificates, etc. are eliminated. Third one is it eliminates handling of huge volumes of paperwork involved in filling the transfer deeds and lodging the transfer documents and share certificates with the company. Now fourth one is there is immediate transfer and registration of the securities at the end of every settlement cycle, which is 4 working days, that is T plus 3, and there is no delay on account of processing time. Now fifth one is it leads to transfer settlement cycle and faster realization of sale proceeds, so the fund of the investor is not tied up unnecessarily. Now the sixth one, the system facilitates a faster disbursement of security holding benefits like rights, shares, bonds, bonus shares, etc. Now the seventh one is the stamp duty on transfer of securities, which is a 0.25% of the consideration on transfer of shares in physical form and is not applicable. Now eighth one is there is a reduction in rates of interest on loans granted against pledge of dematerialized securities by various banks. Now the ninth one is there is reduction in brokerage for trading in dematerialized securities. And the last one, that is 10th, there is reduction in transaction cost in dematerialized securities as compared to physical securities. 11th one is availability of periodical status report to investors on their holdings and transactions is disseminated or spreaded by the depository. So these are the benefits to the investor. Now next is benefits to the company. What are the benefits to the company? The first one is the depositor system provides up-to-date knowledge of shareholders' names and addresses to the company. Second, there is savings in cost of new issues from reduction in printing and distribution cost. Third one is it may also lead to increased efficiencies of registrar and transfer agent functions and better facilities for communication with shareholders. Convenient benefits of corporate actions and information policies. Now the fourth one is the system enables a company to attract international investors without by having to incur the expenditure of issuance in overseas market. So these are the benefits to the company. Now let's discuss the next topic, online share trading and its advantage. So what is the online share trading? Online share trading involves buying and selling of stock through online platform. Using the online share trading account, you may buy or sell share stocks, mutual funds, bonds and other securities easily without the need of intermediate broker or agent. Online trading is an act of buying and selling of financial products through an online trading platform. Stocks, bonds, options, futures and currencies can all traded online. These platforms are normally provided by internet-based brokers and are available to every person who wishes to try and make money from the market. You can educate yourself on your investment. Options, place orders to buy and sell possibly make or lose a considerable amount of money without ever speaking to broker or leaving the comfort of your home. Online trading has a lot of benefits. Here are 7 main benefits. It is convenient when it comes to online trading. You only need to open a trading account via internet and you are good to go. You are not bound by the time and place as long as you have internet connections. Hence, online trading is convenient and possibly accessible from anywhere with limited hassle. It also saves time, it is cheaper, it is online stock trading. The stockbroker fee which you will have to pay is lower when compared to the commissions charged by traditional methods. If you trade in an sufficiently large volume of stocks, it is possible for you to be able to negotiate your broker's fees. You can monitor your investments anytime. Online trading allows you to buy or sell shares according to your convenience. It offers advanced interfaces and ability for investors to see how their money is performing throughout the day. You can use your phone or your computer to evaluate your profit or loss. Online trading almost eliminates the middleman. Online trading allows you to trade with virtually no direct broker communication. Apart from reducing the overall trading cost, this benefit also makes the trading hassle-free, make this service much more lucrative. Investor has great control. Online traders can trade wherever they wish to. On the other hand, in traditional trading, an investor may be stuck until he or she is able to contact their broker or when the broker is able to place their order. Online trading allows nearly instantaneous transactions. Also, investors are able to review all of their options instead of depending on broker to tell them the best bets for their money. They are able to monitor their investments, make decisions and buy, sell stock on their own without any outside interference, thus giving them greater control over their investment. Next is faster transaction. Online banking is fast and efficient. Funds can be transferred between accounts almost instantaneously, especially if the two accounts are held at the same banking institution. All it takes to be able to buy or sell stocks in a single click of mouse. Through this, a quicker exchange can be made, which may also ensure quicker earnings. Next is better understanding of one's money. There is a hidden advantages of online trading which you would not want to pass upon. Just like conventional stock trading, you can predict the market behavior and use this to predict a rise or fall in the price. You will be handling your own finances and be responsible for them. Over time, you become more experienced in understanding the market and good investment opportunities from the bad ones. This knowledge about money is very useful, and having this on your resume makes you more marketable to companies looking to fill a well-paying position in the finance department. So while making a quick buck, you also manage to become financially smarter in both your professional and personal life. Next topic of module 1, concepts of a small cap. So what is a small cap? The term small cap describes companies within a relative small market capitalization. A company's market capitalization is the market value of outstanding shares. The definition for a small cap varies, but generally means a company with $300 million to $2 billion in market capitalization. So this is all about a small cap. Now, difference between large, medium and small cap in share market. So, when beginners enter the stock market, they often have questions about which stock to invest in. Such question can overwhelm even a seasoned investor. Stock market investor must have sufficient knowledge to determine which stocks are the right choice for their investment strategy. If you have no clue about which stocks you should put money in, you could face losses. The share market has inherent risk, and this risk varies from one stock to another. Stocks in the stock market are often classified based on their market capitalization, or you can say market cap. So what is the full form? Market cap is market capitalization, as large cap, mid cap and small cap. So basically large capitalization, mid capitalization and small capitalization stocks. This categorization helps investors to make decision. Market capitalization, its meaning and categories. So first, market capitalization. What is the market capitalization? It refers to the total number of outstanding shares of a company in the market multiplied by the current price of each share. It is a measure of estimated valuation of a company. To make things simpler, let us consider the meaning of market capitalization with the help of an example. So, suppose that ABC company has 20,000 outstanding shares in the market, and each share of ABC company is priced at rupees 20. So what is the price? Rupees 20. Then the market capitalization of ABC company will be calculated as follows. Outstanding shares into price per shares. So 20,000 into per price क्या था? 20 rupees. So it's equals to rupees 4 lakh. Therefore, the market capitalization of ABC company is rupees 4 lakh. So the companies that are traded on the stock exchanges can be categorized into three broad categories: large cap, mid cap and small cap. You can say that large capitalization, mid capitalization and small capitalization. Let us learn about each of them in detail. So what are large cap stocks? Large cap means large capitalization, okay? So large cap companies are businesses that are well established and have a significant market share. Large cap companies have market caps of rupees 20,000 crore or more. So these companies dominate the industries and are very stable. They hold themselves well in times of recession or during any other negative event. Besides, they will usually have been functioning for decades and have good reputation. If you want to invest in a company's stocks by taking less risk, then large cap stocks are good options. These stocks are less volatile in comparison to mid cap and small cap stocks. So the lower volatility makes them less risky. For example, Reliance Industries and Infosys are examples of some large cap market companies that are listed on the stock exchanges of India. Their strong foothold in the market and consistent good performance makes them good choices for long-term investors. So now next one is mid-cap stocks. What are the mid-cap stocks? Mid-cap companies are companies when market cap is above rupees 5,000 crore but less than rupees 20,000 crore. Investing in these companies can be riskier than investing in large cap market companies. This is because mid caps tend to be more volatile as compared to large caps. On the other hand, mid cap companies also have the ability to turn into large cap companies in the long run. These companies offer a higher growth potential than do large cap stocks, and hence more investors are attracted to investing in such companies. Metro Policies Healthcare, Castrol Indian and LIC Housing Finance are some examples of mid-cap companies that are listed on the stock exchanges of India. Now the third one, that is what are small cap stocks. So what are the small cap stocks? The small cap companies are those that have a market capitalization of less than rupees 5,000 crore. These companies are relatively smaller in size and have significant growth potential. What makes them risky is the low profitability. The low profitability that will be successful over time. This makes the stocks of such companies volatile in nature. Small cap companies have a long history of underperformance. But when an economy is emerging out of a recession, small cap stocks often prove to be outperformer. For example, Hindustan Zinc, DB Corp, KNR Construction and Hathway Cable are some examples of small cap market companies that are listed on the stock exchanges of India. Now the next topic of module 1 is penny stock, and this is the last topic of this module. Penny stocks are stocks that traded at very low prices, have low market capitalization and are mostly illiquid, that cannot be easily converted into cash. These stocks, penny stocks, are lesser known to the larger investing public as investors remain away from them because the information regarding their fundamentals and businesses is either not reliable or not available. However, they are also known for multi-bagger returns within certain trading sessions. As penny stocks are mostly illiquid, meaning traded in very less quantity, sometimes only a few orders can lead to hitting the circuit limit on the exchange. These stocks mostly give higher returns when hitting circuits for a number of days. Though this period of hitting circuit is not accompanied with trading volumes, either there is some story moving around that stock, or it might be as a result of manipulation by some stock operators who artificially inflate the price and volumes to bring in innocent retail investors and large offloading their own holdings. When participation increases, now that we have understood what are penny stocks, let's see why are penny stocks called penny stocks. Penny stocks are penny stocks for a reason. So what is this reason? What is this reason? Penny stock traded off such low rates for a reason because Most of the traders buying penny stock don't even care about them and look to exit sooner or later once they have given decent returns. Penny stocks in India are often found non-compliant with exchange regulations and non-transparency in reporting. It is only when there is some news or some turnaround stories on penny stocks that they move. The speculation leads to an increase in trading volumes and prices soar. But very few of them turn out to be true or genuinely fundamentally stronger. Any negative news causes the price to turn south. So this is all about the penny stock.